There is one very obvious factor today. Everyone and every entity are all using the same playbook. The more debt you're in, the better your prospects are. What a joke. But really, that's the way it works. Debt is so abundant, it's so cheap, might as well take as much as you can. Companies that are sitting on massive piles of cash borrow money to buy back their own shares. But with debt comes derivatives and the unbelievable madness that they will unleash. You came here for the truth, so let me unveil that for you. I have an interesting video today. I'm going to get into a few issues. We're going to look at what's going on with the zombies. This is in fact the zombie apocalypse that you should be paying attention to, not the ones on Netflix or whatever other streaming service people are watching. You need to look at everything that's going on behind the system. This system is dirty. There's a lot going on here, and I think what needs to be said up front is that what we are seeing is this calculated and intentional pull coming away from the middle class and into the hands of the globalist elite. This takes place on so many different levels, but if you look at the pension funds and how destroyed they are, and you see what's going on with the central banks as they accumulate more and more, look at all the CEOs and the benefits that they have been receiving. We'll talk about that today. We're going to look at all of this, and over time, people that have been watching this channel, they've been realizing what this is all about. There's more going on than meets the eye, that's for sure. Let's cover some of that today. I wanted to begin with this here because Northman Trader pointed out something that I wanted to mention. Fed expands the balance sheet by only, quote, $3.7 billion in the past week, and markets completely fall apart. It's something interesting. Now, when you look at what's going on here on a percentage basis in a given week, I never like to look at it like this because when you see it on a week-to-week basis, there's always going to be fluctuations. But it is rather interesting that there was a terrible day this week and we had that around this time frame. Who knows? I just wanted to mention it here before I move into the rest and understand that the Federal Reserve, the role that they play in daily events, not just overall, but daily events, is absolutely critical. Massive liquidity cannot disguise a solvency problem. Defaults close to a multi-year high, and that is very worrisome. You could see this record high corporate bond defaults for the second quarter of 2020. It is unbelievable to see where this has come in the recent past, and we know that this isn't the end. It's only going to get worse. That data right there comes from, let's say, May 20th, when you see the most recent data, so it is brand new, second quarter 2020. What I like to focus on with this is the fact that they're all connected to the big D. The big D, of course, being derivatives. When you look at it, it's very important to understand where this all comes in, because people, they don't care about that. What they are looking for is the stock chart that shows all the while that's going up and up and up, so they simply buy in and ride the wave. I've seen many comments about this before, seen many articles about this before. People are simply riding the wave. The Federal Reserve is printing, central banks are printing. I just want to hop on and ride the wave. But we've seen this before, time and time again. Yes, this is the most extreme, but of course, when this does happen, bad things occur. In the end, if you are able to get off at the right opportunity just before that instant panic occurs, oh, then you're going to do just fine. But how many people go in and put double down, triple down, or whatever they need to do and lose everything? I just read somewhere about an individual who went all in. They started buying on margin, didn't realize what the heck they were doing, $700,000 in the hole, and that was in a short period of time too. It's amazing how far and how fast, particularly with margin, you can go. Watch out, it's very dangerous. Now, in relation to this, however, we're seeing corporations basically doing the same thing. So we need to pay attention to as much as we can and always hedge our bets. Non-financial corporate business, debt, securities, and loans, liability, and you're looking at this, of course, seeing it growing over and over all along. We are witnessing one of the worst cases of debt that we have ever experienced in history. Just take a look at this. When you compare it to the GDP, which is what they're doing here, it only gets worse as time goes on. And we didn't think that this could ever happen again. No. They're going to be more wise. They're they're going to be careful, they're going to watch out, and we're going to see order restored. But that's not happening at all. That isn't happening, and we could see that on so many different indicators that I've shown you. This happens to be one of them. That is a problem. Because of the connection to derivatives, of course, that's key. I need to make that point. But just seeing it and the response to all of this debt, when you look at it on different levels, of course, with the government, they're in too much debt. What do? They raise taxes. That's a problem because that lowers people's ability to spend money because they're putting more into the taxation. As a result, it weakens the economy. The same thing can happen with corporations, but that's the reason why today we are seeing this zero interest rate policy, because they're trying to prolong the eventual disaster. What you're looking at here, the red line, corporate profits after tax, all right? Basically going nowhere, and in the last little while, it's actually dipped down with everything else. You look at the blue line, non-financial corporate business, debt securities and loans debt. Essentially, it has been going up and up and up, and now it has spiked here in 2020. This is not good. This cannot end well. You got to really see these together. They should be moving up together if they're going to go up. Debt shouldn't be going up this bad. But when you look at it, yes, they should move together. If there is more profit here, maybe you can have an excuse for more debt, but not this time, that's for sure. US, rising share of companies with debt servicing costs that are higher than profits. We're talking about zombie firms, and that is escalating rapidly. This is unbelievable. Our friends at Deutsche Bank here are providing this chart. But when you look at it, there are so many different companies that are in this position. In fact, it's a lot worse because they use phony accounting. We know that. If you've ever read Frank Partnoy's book, Infectious Greed, which I have a link in the description, if you see what he talked about, you know how they can always push this further out. They can make all of their bad books look bad indefinitely. Some point in the future will make them look bad. So they can manipulate this anytime they want. Regardless, when you see what's happening here with zombie firms, it should be a concern because too many people buy this up. Right now, the trade of the day is buying bankrupt companies. How terrible is that? Governments are no different. You could see this out of the Wall Street Journal. Debt surge. Government debts are set to jump as tax revenues slide and the cost of supporting businesses and households mount. They're giving stimulus one way, shape, or form. And you could see Italy, US, they also give us the advanced economies here. And you have France, Spain, and the UK increasing, all increasing right now. Italy is in a lead, if you want to call it like that. But regardless, over around 150% or so. That is something you cannot fix. You can't fix that. 2001, it was a little bit more manageable, but today, for all of these countries, it's simply impossible. What does that mean? You know there's more austerity coming. You know there's higher taxation coming, and there is a lot less that you're going to get. This is an interesting article out of the Financial Times. If you looked at what happened during the financial crisis 2008, people became really upset because the CEOs were making so much money and everybody else was getting laid off. They were getting these huge bonuses and so on. This time around, you had some CEOs that were saying, okay, I'm not going to take a salary. I'm going to be really cautious here. We're going to cut back, but I'm also going to cut for myself. So don't hate me. We're all on the same page kind of thing. This, however, reveals some very different ways that CEOs have found themselves making a lot of money. Of the 554 companies that had announced cuts to executive salaries by May 29th, the Financial Times found 51 which had both the same CEOs and awards program as last year. Those CEOs had been awarded on average 52% more options or shares than in 2019. They give you several examples here. I'll show you a chart in just a second, but think about what happens here. With all of these different companies, the executives are always getting stock. The salary might be a very small percentage of their total compensation. And that's why share buybacks are so important, because as they are going ahead and pushing the stock price higher with the share buybacks, there are these moments in time where they are able to sell off if they've got these options. So they do so strategically, pushing the price up, they cash out, somebody else buys in. It happens over and over and over and over again. The CEOs know what they're doing. And of course, these CEOs are working with all of their friends in the industry and those above who are the puppet masters. CEOs that took salary cuts usually made up for it with substantially more stock or options than in 2019. They give you some examples in here. I mean, we've got Foot Locker and Abercrombie, Comcast is here, Hyatt Hotels, Hilton, Marriott, and so on. If you want, you could look at the chart. Let's move on. A little bit of humor for you. TikTok for financial advice. Young people are turning to the video app for tips to weather the recession. In fact, if you go there, everyone's giving financial advice straight up. They're telling you which stocks to buy. These people who are very inexperienced are getting in, and as the stocks have been going up, they feel very smart, so they're going in, they're doubling down. The only problem with that is it's very similar to what we saw back in '99. People were buying into anything and everything. If it had a .com on the end of it, they put everything, they put their life savings, and people got screwed over. Oh, but this time is different. The Federal Reserve is there. Well, let me tell you, if you want to go back in the pages of history, I assure you, the Federal Reserve was supporting the markets in '99. The Federal Reserve was supporting the markets in 2007. As they were denying the problem, they were supporting it. They were keeping interest rates relatively low, at least for that time. If you look at what's going on today, it's no different than times past, but people want to ignore that and do whatever you want. I really don't care, but please acknowledge the truth. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me. I want to thank you for that. If you want to check me out on Twitter, on Instagram, or any other platform, you could do so at The Money GPS. Do you want to learn how to sell stuff online? If you want to understand e-commerce, I've created a free course for you to check out. Other guys selling it for $1,000, $2,000. This one here is free. It's pretty detailed. I'm telling you right now, there's a lot of value in there, especially because it's free. Now, when I made it free, and unfortunately, people take advantage of that, they're really not taking action, and that is unfortunate, but they should, because there's a lot of opportunity. The AmazonGPS.com. Do you know what's going on in the financial system? The root, the core is rotten, I assure you. And I've broken that down entirely in these two books. If you want a full explanation, check it out at the link in the description. If you want the audiobook instead, themoneygps.com. Wait a second, don't go anywhere. You've got to see this video. It's really important. Definitely check it out. I'll see you there.